Students, good morning. I'm sure you all are doing great. I'm also sure that you all have taken the efforts, the pain to study the topic that is going on, to revise at your end. And I assure you, having done this, you will feel empowered in this chapter. And the most important point, which I have been telling you from day one, this is one of the most important topics, not only from the perspective of your inter exam, not only from the perspective of your final exams, but also as a professional, the most relevant head that you will have to handle being a professional every year, every time the income tax computation has to be done. And even where litigation comes, out of the five heads, you'll find majority litigation on PGBP head, obviously because of there being so many sections, there being so many conditions, restrictions, and that is why having a command on this topic is very, very, very important. So students, before I start today, now in the previous class or up to the previous class, we had covered majority of the provisions of this chapter, around 75% of them we have already completed. Plus, I had also given you some homework for practicals. Yes, I know that in the practicals, maybe everything, every provision that is covered in the sum, we have not yet done. But still, at least on the basis of whatever we have studied till now, you would be in a great position, in a good position to understand at least the practical sums, to be able to answer them majorly correctly. So let me first understand from your side, how are you doing in this topic till date? Yes, very good morning, Anshul, Mehak, Isha, Akash, Sridhar, Vishakha, Tanisha, everyone present. Very, very, very good morning. Akash is saying, sir, I have confusion in golden rule point one. Okay, beta. No problem. See, understand one thing. You are having confusion because you have studied on your own. You have tried to solve something on your own. And this is the most efficient path of getting expertise in any topic. That is by solving yourself, having confusions, and getting it clarified in the class. So you say that there is some confusion in golden rule point one, scientific research expenses under 35 and donation under 35. Okay. These both are same things because the section is same. Okay. Good point. So see, Akash, section 35, when today I am going to now take you to sections, all sections, majorly whatever we have done, and few more additional, you will understand that section 35 is not having one provision in it. If you remember, when we started with the debit side provision, where the number was 30 to 37, I said, even though number wise it appears to be 8 sections, but when we are going to deal with it, it will be more than 50 sections, between 30 to 37 only. Why? Because many of these sections have varied provisions, have different provisions in their subsections. Many of these sections have extended sections in the form of A, B, C, D. Now, this question of yours is the best example of this. Within section 35, you have multiple points. In that, one of the points is scientific research. Within scientific research, you have two categories. One, research which is done by yourself. So the assessee, the taxpayer itself is carrying out some scientific research by creating a laboratory, by setting up a team who is doing research and development relating to the business of the taxpayer. So let us say I am into automobile. I am, let us say, Bajaj Auto, or I am Mahindra and Mahindra. You will see in past few years, these two Indian automobile makers have come out with a wide range of products. Earlier, initially, Mahindra, Bajaj, they had very limited range of their vehicles. Now, suddenly in past hardly not more than 5 to 10 years span, they have come out with so many variants. Look wise also now these vehicles are very great. And in fact, Mahindra and Mahindra has now even developed its EV segment. Similarly, Bajaj has also come up with EV scooter. So they are continuously evolving because they are carrying out R&D, and this R&D is done within their organization by having a specific team, having a specific setup where they keep on testing new and new technologies. They develop a product, they test the product, and then these products are launched in the market. This is in-house research. This is also covered in varied subsections of 35, 35(1), 35(2), clause 1, 2, 3, 4, and so on. Similarly, within 35, within scientific research, there is second category, which deals with donation to varied scientific research association who are outsiders. Outsider means now you as a taxpayer are not doing that research, or maybe you are doing the first part, which is in-house research, plus all the established scientific research bodies, associations, laboratories, which are approved by the government, you are making payment to them as a donation. Both are eligible. In point number one of my golden rule, we were dealing with this second type of scientific research where you are making payment to outside scientific research associations which are approved by the government. Obviously, the payment is in the form of donation. And those research, what these outsiders are doing may not be related to your business, but I'm allowing. Whereas in subsection 2, golden rule 2, golden rule 3, we again dealt with scientific research. We again dealt with exceptions of scientific research. Those were the in-house scientific research where you yourself are doing scientific research, where we studied the exception that capital expenditure is allowed. Now, when capital expenditure on scientific research will be incurred when you yourself are doing the research. So you have purchased some machinery, purchased some equipments for carrying out the research. Similarly, for in-house research, there is preliminary expenses, which is again exception to our third rule, that past period expenses are also allowed because before commencement of business, you had done some scientific research up to 3 years before commencement, we are allowing it. Right, Akash? And this is not the only thing in 35. 35 is one of the most vast sections which covers so many different types of deductions. Scientific research is one of them, and within scientific, you have these two types. All are covered in 35. Is this clear, Akash? And I hope it is also understood by others. Good. Yes, students, who all have further queries and questions. Today, let me start with your queries, whatever they may be. It may be one section specific, it may be one point specific, anything till now, whatever we have discussed and whatever you have studied at home, you have revised at home, and you are getting some difficulty. Tell me. So we have this reconciliation format. Then we have our steps, step 1, step 2. Within step 2, we have all the provisions covered into two categories, credit side and debit side. And we have covered today from 28 to 43B. Yes, between them, few sections are to be dealt with in detail, but we have covered it. All these sections from 28 to 43B together decide how to find out PGBP income, what incomes will be allowed, which is the credit side provision, what expenses will be allowed, which is the debit side provisions. Within expenses, some basic conditions, which I'm calling as golden rules, plus some additional restrictions or disallowances. Both these combined together decide what will be finally allowed in PGBP expenses. Yes, students. Mehak says, sir, when solving TYK questions, what is TYK? Some points are yet. Yes, that is what I'm saying. But that is okay, na beta. See, I myself have told you today that out of these sections, few are yet to be done or understood in detail. So I agree to that. But that is okay, na? See, till date, we have not covered everything. So you may not be able to solve the entire question correctly. But see, many times what happens, even though you are not able to solve it by yourself, but at least when you have attempted that question, you will be able to understand the concept better. So that is why I say this is also one of the this is all during our times there were no classes, rather there were except our module, and many times things were not so clear. So my approach of studying was twofold. One, reading the theory and trying to understand. Second, try this also sometimes. I used to directly go to the practical sums. I used to read the question, I used to read the answer, and many times by reading the answer, I used to understand, okay, this is what the section tries to say. And then when I go to the theory provision, it understands better. See, many times with practical, if you try to go to theory, it connects more. That is why in our class, also in the very first day, I explained you the format and we even did the format practice, which you all understood. Now we are trying to fill in each of the provisions one by one. Correct? Yes, students. See, understanding learning is a journey. Even if we complete our entire syllabus, which we'll do in this and next session, that is not the end of PGBP. In fact, I'll tell you, when you join articleship, you will understand the real impact, the real actual knowledge of these topics. Because in your articleship, which is I'll tell you, your life's biggest understanding learning forum, means more than what you are doing in class, more than what you are studying from books, what you will study in those 2 + 1 year of articleship, that will be the deciding factor of your career, the entire career of 30, 35, 40 years, whatever you will be having. Okay, Tanisha, I'll take up those questions, what you have not understood. Anyways, today we'll be dealing with all these things. So students, now today again, we will revise, summarize, but today I will revise section wise. Till now, I was revising as my approach of solving the sum, so credit side provisions, debit side provisions. But now we will study this from module section wise, correct? So now it may not be that these are debit side or credit side provisions, but these are specific provisions for specific items. Let us go to this part now. So, 1 second. If you all have, you can also parallelly open your modules. I'm on the last part of the module, which is let us recapitulate, so that here we get entire chapter in short, so that it will help us in summarizing, revising whatever we have done. Plus, in this part only, I'll try to cover all the other sections which we have not yet covered individually, but we have covered overall while studying our golden rules, studying our restrictions. But today we'll cover all those sections individually. Also, in this process, you will get answers to some of the doubts which you may have had while solving the practical sums. So we'll first do this. Then I'll go to the practical sums which we discussed or I gave you for homework. Then I'll come back, and then there are few sections which today also right now I'll be leaving, because those sections we have to do individually, independently in detail, because you may expect individual questions also on those sections, and those 4 5 sections are one of the most important individual sections of PGBP chapter also and of entire income tax also. So we'll be dealing with those 4 5 sections in great detail. So let me first start. So first section that is covered over here is method of accounting. If you remember, in our first class and in our last class, in both I had explained you that for the purpose of two heads. What are those two heads? PGBP and other sources. Section 145 gives you an option. You can compute the income either on cash basis or on accrual basis, whatever you are regularly following in your books of accounts. For other heads, in the previous class, I had given you what other heads method is, right? For salary, it is cash or accrual, whichever is earlier. For HP and for capital gains, it is only accrual. But for PGBP and OS, it is either as per your choice. Then comes section 28, which is one of our credit side provisions. That is, it decides what income will be covered. So first is the direct receipt from business, and then all the indirect receipts, in which the first one is the compensation. If you remember in the first class, I had discussed this entire section in detail. So first is compensation that you receive either because of termination or because of modification. Now, in what things? First, you are managing the affairs of a company, either Indian or any other, that is foreign company, and now these are taken over by the government. Now they will be managing it. Or you are having agency of some company. Now that agency contract is terminated. Or you had some property or business, the management of which is now going to vest in the government. Or there is termination again or modification of any contract relating to your business. So all these are your business related rights, which are either terminated or which are taken over. I had given you a few examples of this. That is what is covered. Then comes the third point, which is dealing with our institute. So if there is any trade, professional or similar bodies, and they are providing specific services to their members, that will be considered as business, and the receipts from that will be covered under PGP head. Then for exporters, they realize these additional benefits besides their actual business of exporting. These are some additional benefits that they realize. So these are indirect benefits arising out of their export business. This is also part of PGBP. Then while doing business, if you derive any benefit or perquisites, or you can also call it as gift, which is arising from your business or profession. Again, we had discussed examples of this. So you are a distributor of, let us say, Britannia, and Britannia has given a target of 1 crore sales. If you cross that target, you will be given a bullet. If you cross 10 crore target, you will be given a four-wheeler. If you cross 20 crores target, you will be given a foreign trip along with your family. So these are some gifts or benefits or perquisites that may arise from your business, which may or may not be in the form of money. In fact, they will many times be in the form of perquisites like benefits, which I gave example. But since they are arising from business, part of PGBP. Then if you are a partner in a partnership firm, then the partnership firm will give you interest, salary, bonus, commission, and also share in profit. All these three things will be part of PGBP head. Out of this, your share in the profit of the firm will be exempt in your hands. That is, you do not have to pay tax. Why? Because your firm has already paid tax on that profit. So whatever share in profit you receive from your firm, and even LLP, because LLP is treated same like a firm for the purpose of taxation. So it will be first covered in your PGBP head, and here it will also be shown as your exempt income. But interest and salary, bonus, remuneration derived from firm is taxable in your hands. Today we are going to deal with, today or in the next class, a special section dealing with computation of this interest and remuneration in the form of 40 clause B. Then non-compete fees. So you are starting a new business, and I'm already an existing business in the same field. So I may enter into a contract with you, asking you either not to carry out your business in that particular area where I'm doing, or not to share any particular business related trademark, copyright, etc. Why? Because that will hamper my business. So I enter into a contract, and under that contract, I am ready to pay you some amount. This amount is called as non-compete fees, and it will also be taxable in your hands under this head. Then keyman insurance policy, if it is received by the employer, that is the business, it will be taxable under this particular head. And these 2 points I have kept aside for the time being, that we will deal with once we go to the respective section later. Now, all these items, if you see, they cover what in section 28? The direct receipts from business and the indirect receipts arising out of your business. All these are covered in section 28. Now, this section 28, which we just studied above, is defining what receipts are covered under the business head. But understand the students, we pay tax on the net profit, not on the receipts. On the receipts from the business, you will be paying GST if you study in the GST topic. However, in this topic of income tax, we do not pay tax on the gross amount. We pay tax on the net amount, which is also called as net profit in our accounting sense. Now, how to cover the net profit? 28 gave you the list of those items whose receipts will be covered under the business head. Now, to compute the net profit out of these receipts, section 29 is the section which simply says to find out the net profit arising out of these receipts, which are covered in 28, you have to follow section 30 to 43D, and these are the sections dealing with your debit side, that is expenses. In between these sections, one of the sections again will be dealing with the income side, and another section which will be dealing with what value should be taken for land and building. So except these two sections in this category of 30 to 43D, all other sections are exclusively dealing with the expenses that are covered. Arun, but I did not get what you have asked. Can you just elaborate? What did you mention? Okay, so what you want to say? But insurance claim, okay. What you want to say? Either type it or unmute and speak. Yes, you can now speak.
Sir, actually, I asked an insurance claim also we going to pay tax after we get our money, and the government grant also we going to pay on the receipt basis, not on the accrual basis.
Okay, correct. So I didn't get what you want to say.
Sir,
Means what you're
actually,
trying to
you
emphasize.
told that a compensation only you going to pay under the receipt base. So that reason I told another two example.
Okay, so you are giving example of the compensation.
Yes, sir. Thank you.
Okay, but fine. Now, students, we are on the debit side, that is the expenses side. Now, within the expenses side, total sections are these, as I said. In this, there are two sections which are dealing with the income side, all other are dealing with expenses. But within this, if you remember, I have divided the expenses side into two parts. First is section 30 to 37, and then section 40 to 43B. Now, why I have divided this? Because this part covers the list of all expenses on which you can claim deduction. So now when we'll deal with 30 to 37, you will find the names of different expenses which the PGBP head says I will allow as deduction. And for each of these expense, they have given some conditions. So in section 30 to 37, each section covers some expenses, names of certain expenses. Now try to just recall your trading P&L debit side. One by one, we will find one names appearing in these sections. And in every section, whatever expenses they have covered, they say that we will allow these expenses in PGBP. It means while computing PGBP, you can deduct those expenses from your receipts, but subject to conditions. And then there are different conditions. Now, when we studied with the practical perspective that when you are solving the sum, For you, the name of expenses, whether it is 30 to 37 is not so important. What is important for you is to decide whether it will be allowed as deduction or not allowed as deduction. Now, for deciding this, that whether it will be allowed as deduction or not allowed as deduction, you have to remember the conditions. Now, when we go to each sections one by one, and when you read it from the module in the detail part, you will find that in all sections 30 to 37, they have given the list of the names of the expenses and they have repeated the same conditions. Now, since the same conditions are repeated, in our initial lectures, we approached all these sections not from the perspective of what is covered in 30, what is in 31, rather from the perspective of conditions. So that when you are solving practical question, when you see the trading P&L list, you simply go to each of the expense and check whether these four conditions are satisfied, right? And that is what I called as golden rules and the exception to those rules. So now, today we are going to study these sections individually with the perspective of understanding which section covers which expense, right? In that conditions, you will find what we have already studied. So broadly, there are four golden rules, that is four conditions. First, it should be related to business. Second, it should be revenue. It should be current year and it should not be an offense. Simple. However, for some of these expenses, one or two of these conditions may not be present. Why? Because they are exception to these rules. This is how we have studied. And then after completing 37, we will then go to the second part of debit side where these sections cover restrictions. So though you are allowed certain expense here, but some of those expense are put some additional restrictions in these sections. And then those expenses will be finally allowed as deduction only if you satisfy and complete those restrictions. So let us see what all these sections cover. So first section is 30. It covers your expenses on the building. Now see the first condition. It should be used for the purpose of business. This is our first golden rule. Then the second condition is it should not be in the nature of capital. Current. Third condition is it should be of this current year. And fourth condition, it should not be an offense. Now, what are the expenses covered? So rent, rates, taxes, repairs, insurance, all these expenses, you remember we already cover these in P&L. These are also allowed in PGBP, but subject to fulfillment of all these conditions. Similarly, what does 31 covers? It covers same expenses. See, repairs, insurance, but now of your other assets. What are the other assets besides building? You have machinery, you have plant, you have furniture. Again, same condition. It should be for the purpose of business. It should not be capital. Now here they may not have given all the conditions again, but if when you read the detailed part of module, these sections, you'll find the same four conditions repeating. Then section 32, which is one of the most important sections in PGBP in entire income tax. It allows you deduction of, again, what you commonly see in accounts, study in accounts, that is depreciation. Now, for getting depreciation, there are some conditions and there is some calculation, which we are going to study in the later part of today's session. So I'm keeping depreciation detail part aside. For the time being, few pointers. First, the act says it is mandatory. Mandatory means you are not given a choice whether to debit depreciation or not to debit. You have to compulsorily debit depreciation every year. Now, in condition, same condition, it should be used for the purpose of business. Now, this part, what is 50% 180 days? That is the practical part that we'll understand. Second, it may be wholly or partly for business. Now, whenever it is partly, there is a section 38 which says if you are using an asset partly for business and partly for personal, like let us say you are having a flat on rent. Front side of the flat you are using as your office and back side you are using for staying. In the initial part of everybody's practice, this is the common thing what we do, right? Now, in such cases, section 38 says that in all these expenses, 30, 31, 32, whatever we are studying, Where the asset is used partly for business, you will claim only proportionate depreciation. Then the next condition is depreciation is allowed on the WDV basis. All this part we will study when we are going to see the practical part. And then see, this is the practical computation of depreciation. Fine. Now, interestingly, just for this point, what we are studying, depreciation in income tax has two types of depreciation. One, let me call it as regular depreciation, and second is additional or extra depreciation. Now, this is very interesting. Income Tax Act allows two types of depreciation. Now, first point, this extra or additional depreciation is allowed only if you are shifting out of the new scheme, that is, you are covered in the old scheme. For new scheme, there is no additional depreciation, there is only one depreciation. First point. Second point, additional depreciation is not allowed to everyone. So firstly, you should be in the old scheme. Secondly, additional depreciation is allowed only where you are engaged in the business of manufacture or production. So where you are in trading business, where you are in service sector like banking, insurance, etc., you are not given additional depreciation, you are only given the regular depreciation. So 2 points for the time being you keep in mind. One, additional depreciation is allowed only under the old scheme, not under the new scheme. Two, it is allowed only to manufacturers. And then again, this is dealing with the computation part, which we are going to deal further. Then comes section 35. Now today, while answering Akash query, I had already mentioned that 35 itself covers many different expenses. Now we'll go to all these one by one. The very first is scientific research. Within scientific research, you have two categories. What are those two categories? One, in-house research. One, where you are making payment to outsider. Correct? Now, for in-house research, you are allowed deduction for both revenue as well as capital. This is where we had that exception point that in scientific, even capital expenses are allowed, but with scientific in-house. So for in-house scientific research, you claim both types of deductions, revenue, capital, correct? Then besides this, you also are allowed expenses which are incurred by you in 3 years preceding the commencement, which again is what? Preliminary. So this was another exception in scientific, that scientific allows preliminary. Now, most important, the second part of scientific is where you are making payment to outsiders. So here you are given the word contribution, you can also call it as donations. But this is allowed only when you are out of the new scheme, that is, you are under the old scheme. Now, these outside scientific research associations, etc., should be approved by government. And if it is approved, you will be allowed deduction of entire amount of donation. Most important here, when you are making donation to outsiders, again, our first exception or exception to our first golden rule is applicable. These scientific research for which you are now making this contribution or donation may or may not be related to your business, but still you will be allowed the deduction. So that is what is the important point. When you are making contribution to outsiders, the research done by them may or may not be related. Most important point, this is allowed only when you are out of the new scheme. Then comes some other deductions. Again, in other deduction, there was an old deduction for investment linked. So if you are starting business in some specific sectors, you were allowed deduction. Now, anyways, this deduction is applicable only where you are opting out of the new scheme. So this deduction will be allowed, which is called as investment linked deduction, only when you are in the old scheme. Now see, they have given you list of businesses which you should be entering into, and which is this section 35AD. What is 35AD? If you remember, it was you are engaged in some specified businesses. Now let me explain you what is 35AD in detail. 35AD is a section which was created in order that people started some strategic businesses which the government felt are important for the overall country's development, for the overall country's progress. So, what the government did, they gave you a specific benefit under this section 35AD. But this benefit was given to you only if you are doing these specified businesses. Now, what is that special benefit that this 35AD is giving? This section is allowing you deduction of capital expenditure. Now, what it means? See, you purchase a building for rupees 10 crores or you get it constructed for rupees 10 crores. Now, normally what will happen? Normally, you will never be allowed entire 10 crores as expense in any P&L because it is capital. So what any law will say, even accounts or even income tax, that you take depreciation. So you take some 10%, 15%, 20% of this 10 crores every year, and that is only what you can debit to your P&L. However, when I say capital expenditure is allowed, which is allowed for even this 35AD and even for scientific research, in both cases, when I say capital expenditure is allowed, it means what? It means this entire 10 crores expenses that you have incurred in purchasing or constructing the building can be debited to P&L immediately. This is what is the meaning of capital expenditure is allowed. Now, what are these specified businesses? So, see the businesses. You are operating, running a cold chain facility, so cold storage. Second, you are operating, running regular warehouse, not a cold storage now, but this warehouse should be for agricultural produce. Second, you are in the business of running and operating cross-country natural gas or crude pipeline network. I'm sure you all would be knowing after this Iran war and the Hormuz problem, now India is strongly working on this pipeline network with the other Arab countries like Kuwait, like Saudi, so that they can bypass the Hormuz because these pipelines will be embedded in the earth or under the sea, and through these pipelines we will be getting the continuous supply of crude oil. Now, it is not that this pipeline we are going to start constructing now only. This, if you see the year, this was brought in 2007, so long back, because it is not for the first time that we are having this type of war. This similar issue or similar large scale war in Saudi countries had happened earlier also in 1990s. At that time, similar problem what we are facing now. In fact, till now we are not facing that great problem. But in that 1990s, it was a complete stoppage of oil supply. And every country, including ours, was badly impacted for months. So since then, the government had this thought process that we have to find an alternate solution. Now, what is that solution? So now, again, after this present war, the government is now again aggressively going to work on this particular concept that they are laying a direct pipeline from the Saudi countries to India. Obviously, some part of the pipeline would be below land, some part would be below sea, but now that is what is being worked upon. Now, you are the private person who are going to lay down the pipeline and also operate this pipeline. This is what is the nature of your business. So again, this becomes a very critical business for the country. So it is put in this category of specified business. Then the government also wants to promote good facilities for the citizens. So they have kept the hotels also in this business. So those who are running 2-star or above category of hotels will also be considered as specified. Similarly, hospitals are also need of any civilization. So whoever is Running and operating hospitals with minimum 100 beds is also covered. Similarly, having houses is also significantly important for any society. So all builders, developers who are into construction of housing project, but not all housing project, only the not notified projects, and which one is notified? Slum redevelopment. So now you would be knowing in India, in major parts or in some major cities, there is a big drive happening where the government is now trying to reconstruct slums. Already this drive has happened in some other parts. Presently also it is undertaken in different parts because the government wants to provide these slum dwellers a better place to stay. So how this will happen? So all their jhopadpattis will be converted into pakka makans. This is what is slum redevelopment. So those builders who are doing this, they get the benefit of 35 AD. Next, again, housing project. Now this is not the slum redevelopment. It is constructing the affordable housing. Again, for the lower middle class or middle class who cannot afford big houses, who cannot afford very costly houses. So for them, those builders who are making small and economical value houses, they will get the benefit by getting covered under this section. Further, fertilizer. I'm sure you would be knowing this. Present Iran war problem has also created a big shortage of fertilizer because India is importer of fertilizer. Whatever fertilizer which is nowadays very important for our agriculture, a good part of it is being imported. So again, government wants to promote the production of fertilizer in India. How it can promote? By giving them special benefits. So that is why this is also covered in 35 AD. Similarly, setting up and operating inland containers depots or freight stations. These are the places where goods are stored at the time of import export in the customs. Then honeybee keeping so that you can get wax, you can get honey. Then warehousing facility for sugar. Then pipeline for transportation of iron ore. Then semiconductor. I'm sure you all have heard this word, semiconductor manufacturing units. And last, development of infrastructure facility. Now, these are the varied businesses which are covered in 35 AD, right? Now, I have some pointers in the chat box. Sridhar says, Sir, MADA scheme, yes, correct. Then Lakshmi says, commencing operations. Now, students, for all these businesses, there are different dates given. Why these different dates are given? Because this section 35 AD entire section was not created on day one. When the government thought of starting to give this particular benefit, they introduced 35 AD somewhere in 2007. At that time, all these businesses were not identified and put in the list. These are getting added to this list over a period of time. Like you see, the last one was added in 2017. So as and when the government finds the need for any specific business to be promoted, developed, they are adding it in 35 AD. Now, Dhanlakshmi has a very valid question, sir. Are we supposed to remember these dates? Answer is no. You have to only remember in 35 AD the names of the businesses which are covered, that is, which are eligible for 35 AD benefit. Next, somebody is asking, sir, do fertilizer business people complete? No, 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 no. But there is no exemption to fertilizer business people. Please don't misinterpret. It is not that these sections are giving exemption. What is the benefit? I have already mentioned. If you're running any of these businesses, I've already mentioned here. See, what is the special benefits? You will get deduction for capital expenditure. See, that is what is given here. For you, the entire capital expenditure, except land, goodwill, and financial instruments, like when you invest in shares, etc., you call them as assets, but that is not anyways eligible for deduction. So, except land, goodwill, and financial instruments, all other capital assets like plant, machinery, building, furniture, for all these, if you are in any of the above specified businesses, you can take the entire deduction in the first year itself, which indirectly means what? That since you are taking the entire deduction in the first year, now you are not required to claim depreciation? Obviously, because if entire capital expenditure is allowed in year one, why will you claim the depreciation? So what is the first special point, or rather the main special point of these 35AD businesses is that they can take the entire deduction of capital expenditure in year one. This is what is the special point for 35AD. Plus further special points are, when you will study set off chapter, you will realize that for other losses which you incur, there is a time limit up to which you can carry forward them in future and set off. But for this 35AD business, the losses, whichever you will incur in this particular businesses, which are covered in 35AD, can be carried forward for infinite time. Like for other losses, there are 8 years time limit up to which they can be carried forward for other businesses. But for 35AD business loss, these can be carried forward for 10, 15, 20, 25, 40, any number of years until they are fully set off. So these are the special benefits which the government has given them. They have not made these businesses completely exempt. If they had to make these completely exempt, they would have put these names in section 10, which is the exemption list. So it is not having full exemptions. So it is not kept in section 10. They are given these special benefits which are not available to other businesses. Like as I said, other businesses do not get entire capital expenditure benefit. They can claim depreciation, but entire amount is not allowed. Similarly, other business losses can be carried forward up to 8 years. This particular 35AD business loss can be carried forward for infinite years. So these are the special benefits given in 35AD. But also now you have to keep in mind, all this is only if you are under the old scheme. If you are in new scheme, 35AD benefit is not there. When I say 35AD benefit is not there, means these businesses will be considered as normal businesses and you can claim depreciation. Then this entire amount of capital expenditure is not allowed. Fine. Okay. Further, now what else? Even the capital expenses which you have incurred before commencement of business will also be allowed as deduction. Only condition is they should be capitalized in the books of accounts. So simple point. So whatever capital expenses you are incurring, one, when the regular business is going on, that is also allowed. And capital expenses which were incurred even before, prior to commencement of your business, which were capitalized in the books, will also be allowed. In short, whether capital expenditure is current year or it is your preliminary, both capital expenses are allowed. Now, some restrictions to 35AD. Now, till now we were dealing with what are the benefits. Now we are going to come to restrictions. First restriction. Now this point, if you remember, we had studied already in section 40A bracket 3. So that 40A section bracket 3 has been applied to 35AD also. What was that? That where you are incurring an expenses of rupees 10,000 in a day, right? So whenever you are going to incur an expenses in a day for one single bill exceeding 10,000, then while making payment of this amount, you should only follow the prescribed mediums. Now, what is the prescribed medium? First, it should be either by way of account pay check or draft, right? Check or draft, or it has to be through the electronic medium. If you are making payment in cash or bearer check or even cross check, then the amount will be not allowed as deduction. It will be allowed only if it is paid like this. If it is not paid like this, it will be disallowed. So if you are making payment otherwise than these mediums, then you are not going to get deduction. In other words, for getting the deduction of expenses under 35AD, and which expenses? Capital expenses, and definitely capital expenses will exceed 10,000. You should ensure that the payment is made as per this requirement. Next, second restriction to 35AD businesses. Now, we have some other beneficial sections, 10AA, chapter 6A, all these sections are giving some special benefits. And let me inform you students, all these special benefits are only under the old scheme. This is a general rule you can keep in mind. All the special benefits given under the Income Tax Act in various chapters, special benefits, are no more applicable under the new scheme. So all these 10AA, chapter 6A, whenever you will study, you will get to know that these are also giving special deductions, like how this 35AD is a special deduction. These sections are also giving special deduction. Now, in these sections, again, they are giving special deductions to some specified businesses specified in those sections. Now, it may happen that there is overlap. What is overlap? The same business is covered in this 35AD also, and the same business is also getting covered in either chapter 6 or 10AA. Possible, because see, in different periods of time, these different sections were implemented or they were added in the act, and there were different governments operating and those years. So everybody had their thought process. So when these different sections were created, there is a possibility some businesses which were added in these sections are common with 35AD. Now, what does this restriction says? This restriction says one simple thing. If the same business is covered in multiple sections, you cannot get the deduction for the same amount multiple times. Like when you have incurred capital expenditure here, you are claiming deduction under 35AD. Now, if the same business is given some special benefit under Chapter 6A, you cannot again claim the special benefit of Chapter 6A also or 10AA also. In other words, you can claim the special benefit only under any one of the sections. So simple, what they are saying, non-eligibility for deduction under these other sections. So it simply says that you have to decide whether you want section under 35AD or chapter 6A or 10AA. So for the same business, you cannot claim multiple deductions. Samiran is asking, sir, can we claim depreciation? See, Samiran, understand one thing. Section 32 deals with depreciation. I'm yet to come on the section 32 in detail because that we are going to do specially, because that has a special benefit or weightage in your exams, right? I'll come to that section in detail. But right now you have asked me a simple question, whether you get depreciation on immovable property. Understand one thing, go back to your accounts. Logic is same. In accounts, you get depreciation of one type of immovable property, which is building, but you don't get depreciation on the second type of immovable property, which is land. Correct? Same logic follows everywhere. No depreciation is allowed for land. So even 32 does not allow depreciation. Even in this 35AD, where we are giving deduction for capital expenses, if you remember, we studied about except land, because land is a non-depreciable asset. So you will get depreciation under 32. When we'll study 32, you'll see that. But land is not allowed. Yes, building is allowed. Now, compare 32 with 35AD. What is important to be noted, Samiran? That if you are coming under 35AD, firstly, it will be possible only if you are in the specified businesses. Second, if you opt for the old scheme. Importantly, if you are coming under the old scheme, that is opting for old scheme, then if you take 35AD benefit, what will be the benefit? As I was giving you an example, you purchase a building of 10 crores, you can debit entire 10 crores to P&L immediately, right? But important, this amount of 10 crores, which is debited immediately to P&L, now will not be eligible for depreciation. So now I'm saying the building will not be eligible for depreciation. But why? Because you're already claiming the entire 10 crores under 35AD. But those who are not covered in 35AD or those who are not opting for the old scheme, it means for them depreciation is the only option under the new scheme. So they will be claiming depreciation. And in that case, this 10 crores building will be eligible for depreciation. Samiran, I hope I could clear your doubt, right? But I already clarified, land has no depreciation anywhere, neither in accounts nor in income tax, because land is not considered as a depreciable asset. I'm sure you all would have studied this in standard 11th also, when you first started studying accounts and when first time in your accounting syllabus the concept of depreciation came. correct? So land, no depreciation, no deduction. Fine, great. So this is the second restriction to 35 AD. So first restriction was payment exceeding 10,000 should follow these mediums, otherwise it will be disallowed. Second, for the same business, you cannot claim deduction, special deduction under other sections. So you can claim any one special deduction, which will be your choice, whether 10AA, 35 AD or Chapter 6A. Third, now this point is to be understood in a proper manner. What does this point says? Now in 35 AD, we are saying that we will allow you deduction of your building. So let me just show you in a pictorial form. So what does 35 AD says? You have purchased a building of 10 crores. Now you can debit this entire 10 crores to P&L immediately. This is what is the meaning of capital expenditure is allowed as deduction, correct? Now, once you have claimed this deduction, let us say this is P&L of 2022-23, the year in which you had purchased this building. No need to claim depreciation. So you don't need to go to 32. Entire 10 crores is debited to P&L. Right? Now there are two restrictions or conditions put upon you. First restriction or condition is that this building on which you have claimed the entire amount as deduction under 35 AD, this building should be used in this 35 AD business compulsorily for 8 years. In other words, before 8 years, you cannot transfer this building to any other business. Now you'll say, sir, what it means? It means that if you had purchased this building, let us say in my example in 22-23, and you have debited the entire 10 crores, that is the capital expenditure of this building to P&L. In short, you have taken the entire deduction as per 35 AD. Now, from this year up to completion of 8 years. So 8 years will be completed in, right? So first year is 22-23 and there more 7 years. So it becomes 29-30. This will be your 8th year. Till this year, this building should be used in 35 AD business only. It should not be used in any other business. Now what it means? It means, now this point has very limited application, but they have put this as a clarificatory restriction. What it means, let us say you are having other businesses also. Now many times it happens that a single person may be running multiple businesses. Now when you are having other businesses also, many times what we do is we purchase some asset and that asset we use in multiple businesses because all are my businesses. So let us say I am a manufacturer. Let us say I'm this fertilizer manufacturer. This is one of my business. Second, I run a restaurant. Third, I let us say have a trading business of pharmaceutical products. So I can have multiple businesses. Now I purchased a building, this 10 crores building, and I declared that this building is 35 AD business. That is for only the fertilizer business. So let us say it is a 7-storied building in which I have created office for my fertilizer manufacturing business. Allowed 10 crores allowed in my fertilizer business because it is 35 AD. But over a period, I want to use the ground floor of this building for my trading business because the building is in prime location. If I start my trading business over there, then it will flourish. So I want to use the ground floor for that. Or I want to now use the first floor for my other business, which is, let us say, my CA consulting business. Now, this is not allowed. So what it says, once you have claimed deduction of a capital expenditure under 35 AD, right? Then for 8 years, this asset should not be used for any purpose other than this specified business. In other words, you should not use it in other businesses. But what if you do it? So if you have started using this asset in other businesses, which is actually not allowed up to 8 years, but let us say you do it, then in that case, you will be required to show this amount as your income. Means what? When you will shift this asset to some other business, let us say this is P&L of my other business. I shift this asset to other business, means I start using the building for my other businesses. Now what will happen? You will have to credit your P&L with the depreciated value of this building. So if you do it within 8 years, then the amount which I allowed as deduction here will be deemed to be my income in the year in which I shift this building to my other business. This is what is covered in section 28. So I'm just scrolling above, because if you remember, I had left something in section 28 and I said we will deal with it later when I come back or when I deal with that point. So see, this is that point which I had left. What it says, that where any sum is received by you, and it is dealing with what? In respect of that capital asset for which you had been allowed deduction under 35AD. So if there is any asset for which you had claimed deduction under 35AD and now you are transferring that asset, then whatever amount is received by you, that amount will be treated as your income under PGBP. So this is what is the exact point I'm trying to explain over here. So this point says that 1, you should not sell this building. If you sell this building, again, it will be treated as your PGBP income, point number 1. Point number 2, you should not transfer this building to your own any other business up to 8 years. If you do any of these things, then it will be treated as your PGBP income under section 28. Students, I hope this is clear to you all. So this is section 35 AD. So what are the key points of 35 AD? First, government has identified certain businesses to be treated as special businesses. If you are engaged in any of these special businesses and you opt out of the new scheme, that is, you want to be taxed under the old scheme, then 35 AD applies. What does 35 AD says? You need not claim depreciation. You debit the entire capital expenditure to your P&L in the first year itself and claim the deduction. Further, even where you have incurred capital expenditure before starting off business, you can claim the deduction once you have capitalized these in your books. So capital expenses, you can claim deduction immediately in the year of purchase. No need to take depreciation. Only exception is you cannot claim deduction of land, goodwill, and share debentures, which is financial instruments. Other than this, all other capital assets can be claimed as deduction under 35 AD, right? And then there are restrictions. Whenever you will make payment, obviously the payment will be exceeding 10,000. You have to follow the restriction which you study in 40A3, that is payment should be made by these specified mediums only. Second, you cannot claim double deduction, that is for the same specified business. You are claiming in 35 AD also and under any of these special sections also not allowed. Only one of the special deductions is allowed. And third, if you sell this asset outside, the amount received will be treated as PGBP income, or even if you are not selling, if you are shifting this asset from your 35 AD business to any other business within 8 years, you will be required to pay tax. This is 35 AD in detail. Akash is asking, sir, what percentage is treated as income? Akash, first possibility, you are selling this asset outside. If you are selling this asset outside, then whatever amount you receive will be treated as your PGBP income. If you are internally shifting this asset, Then I have written over here the depreciated value of the building. How do you find out depreciated value? So cost of the building was 10 crores. Let us say you have used it in 35 AD business for 5 years. And then in the sixth year, you are transferring to your hardware business, to your other business, which is not 35 AD. Then 10 crores minus depreciation of 5 years. Now, how will this depreciation of 5 years be calculated? That you'll study in the depreciation chapter where rates are given. So for different assets, the income tax law has given different depreciation rates. In the present example, since we are considering the example of building, the percentage of depreciation is 10%. For motor car, it is 15. For plant and machinery, it is 15. For some other plant and machinery, it is 40. So there are different rates given in the Income Tax Act for different assets. So you will have to reduce the depreciation of those 5 years, and then the depreciated value will be treated as PGBP income in the year in which you shift this asset to the other business. Fine, beta? Akash? This is interesting question. So Dhanlakshmi is asking, sir, whether I will record this building in my balance sheet. Because in my 35 AD business, if I am taking the deduction of this whole 10 crores in the first year, will I show this building as my asset in my balance sheet? Students, keep one thing in mind. Now, this is a very important question which Lakshmi has asked. Now, what important thing you have to keep in mind? See, you first studied accounts. So then in accounts, when you studied for the first time, you realize that there is something like P&L, something like balance sheet. So from your trial balance, either the amount goes to trading P&L or it goes to balance sheet. This is how we all understood, correct? And then you realize that if there is something, an asset, it will be shown in balance sheet and every year it will be carried forward. And only the depreciation portion is debited to P&L. And the balance amount is carried forward in assets in balance sheet, right? Now, important point is that when now you are studying income tax, tomorrow later you will study GST, you will realize that there is different treatment given in different subjects. Like now in income tax, we just saw that for assets, you can claim depreciation under 32, or if you are in this specified business of 35 AD, you can also treat this as a 100% deduction in the first year itself, right? Now, importantly, what you have to keep in mind that this treatment, like 100% debit to P&L, is given only for the purpose of income tax computation. It has nothing to do with accounts. Keep this in mind. Similarly, you'll study something special or different in GST. Again, what you are studying over there for capital asset is limited to GST. And that is why, interestingly, importantly, that same asset which you are having, like in this example, building, is having a different treatment in accounts. The same thing is having different treatment in income tax. The same thing is having different treatment in GST. And for all these three laws, there would be different amounts. So let us say if you are preparing balance sheet as per income tax, which we do not do. Let me repeat, we do not prepare any balance sheet for income tax or GST, but just visualize you are having three balance sheet, one as per accounts, one as per income tax, one as per GST. In all three balance sheets, you will have different treatments. Why? Because all the three laws have different provisions, different rules. So when you are doing something, you have to follow all the laws. And that is where, as a chartered accountant, we are always required by the industry because we are the expert of all subjects. This is what is special. We also understand accounts. We also understand Companies Act. Now, interestingly, between accounts and Companies Act also there can be difference, because Companies Act, when you study over there also they have given provisions relating to depreciation, and plus over there is a special schedule given in the Companies Act for depreciation rate. Now, interestingly, you as a company may follow the Companies Act rate, because they have given you the minimum rate. This much minimum should be the depreciation, or you can follow higher depreciation. So in that case, your asset value, your balance sheet as per Companies Act may again be a different thing than as per accounts and as per income tax. So keep this point in mind. That is why I'm just giving 2 minutes to this point, because Dhanlakshmi raised this very important question, that how this asset will be there in your books. It will not change. Whatever you do in income tax, whatever you do in GST, the asset will continue to appear in your actual balance sheet, which is the balance sheet prepared for the purpose of accounts. Correct? Good. Aditya has also put a interesting point. He says, sir, how building can depreciate? It only appreciates. See, understand one thing, Aditya. I am sure why you are saying this, because you are practically seeing that what I purchased today, a flat for rupees 50 lakhs, after a few years it may become of 75 lakhs, and after a few years it may be sold for 1 crore. So you say, sir, the asset value is increasing. How can there be depreciation? Please understand, Aditya and everyone, because this again query may come to your mind at some PA point of time. We studied depreciation in accounts also, in income tax also of building, but many times practically we are seeing that the value is appreciating. Actually, no building value appreciate. Building will always depreciate. See, understand what is depreciation. Now, whichever building you are living in, the structure of the building is depreciating day by day. It is having cracks. Slowly over a period of time, it start leaking. So everything is happening. Means actually the building is depreciating. First thing, you'll agree to this. Now your practical point, but actually in the real world, we see the value appreciating. Please understand, the value of building is never appreciating. It is again the value of land on which the building is standing. So since the land value appreciates, we are, see, in a building, in a flat, obviously the land component is already included. So we are increasing the value of that flat, not because of the structure. Structure is depreciating. It is because of the land component. Correct? Keep this in mind. Good. So 35 AD done. Now coming to another deduction in 35, which is 35D, which is preliminary expenses. Now see, in PGBP, for preliminary, you have multiple sections. Like for scientific preliminary, you already studied something. For 35 AD preliminary, we just studied something. Now this is one more preliminary. Now you'll say, sir, why there are so many preliminary? See, first, you have some specific preliminary expenses section, like preliminary of scientific research, preliminary of 35 AD, preliminary of mining. And second, you have one preliminary section, which is 35D, which is the general preliminary. What is general preliminary? See, all above preliminary, which we just saw in scientific research 35 AD, they were only preliminary of scientific research, only preliminary of 35 AD. But let us say I am not covered in any of that. Normally, when I start my business, before the business gets actually into rolling, before it actually commences, I incur some common expenses before the commencement of business, which your accounts also has asked you to show it as preliminary expenses. Those are general preliminary, which are incurred in general by any business. 35D covers them. Now, what does 35D says? 35D says that we have given you a list of our preliminary expenses. If you are incurring any of these preliminary expenses, then we will allow you deduction of these preliminary expenses subject to few points or few provisions. We will allow you these deduction. Now, what are these points or provisions? First, these preliminary expenses which we will allow should be falling in our list of preliminary expenses. So you should have incurred one of these expenses. Only these expenses we will be treating as our preliminary expenses. Our preliminary expenses means we will be allowing deduction only for these preliminary, not any other. Now, what are these preliminary? So before commencement of business, you prepared a project report. Many times for every business, project report is prepared, feasibility report is prepared, market survey is done, some type of engineering surveys are done, or you hire some consultant, maybe a lawyer, maybe a chartered accountant, a company secretary, for taking some legal advices. It may be for drafting the agreement, for so many things. Now, all these expenses are commonly incurred whenever a business starts. Similarly, if you are a company, what will be further preliminary expenses above, besides the above which we just read? It will be charges that you have incurred for drafting your memorandum of article, for printing your memorandum of article of association, or for registration of company, or expenses which you have incurred for issue of shares or debentures, like underwriting commission, brokerage, etc. Now, all these will be treated as preliminary. So first important point in 35 days, if you have incurred any of these expenses which we consider as preliminary, make a total of this. Let us say the total of this comes to 8 crores. And all this is incurred before you have started your business. So what we will consider as preliminary is whatever you incur before business starts, or even the business has started, but these are related to expansion of the present undertaking. So either it is for a new business or for expansion of existing business or undertaking. Now, let us say in my example, your expenses, one of these or total of all these which is mentioned here, the total is 8 crores. Now comes the second point. What is the second point? Will I give you deduction of this 8 crores, which is the total of the actual expenses incurred? Answer is no. Why? Because there is some qualifying amount. What is the qualifying amount? Qualifying amount means the eligible amount. Now, whether this entire 8 crores will be eligible? So for this, they have given you a limit. What is the limit? Take 5% of cost of project. Cost of project simply means total of your fixed assets. Or take 5% of your capital employed. Capital employed means total of your long-term liabilities. Now, if you are a company can take higher of this 5% of assets or 5% of liability, whichever is higher. Let us say the higher of this 5% asset or liability, whatever is the total of asset liability, the higher comes to rupees 6 crore. Right? So 6 crore, that is out of both these amounts, that is asset total, liability total, you have to take 5% of each and compare whichever is higher. Let us say it comes to 6 crore. So 6 crore is this amount which is the maximum that you can claim as deduction. Now, your actual expenses is 8 crore. Our maximum limit is 6 crores. So obviously you understand, out of this, whichever is lower is your final eligible amount. Eligible for deduction will be rupees 6 crore. So actual expenses or the limit given, whichever is lower, it comes to 6 crores. So 6 crores becomes the eligible amount. Now comes the third point. What is the third point? This eligible amount will be allowed to you as deduction in 5 installments by dividing it by 5 years. So it comes to rupees 1.2 crore. So this is your deduction which you will claim over 5 years. First year, second year, third year, fourth year, fifth year. So like if you remember how we did in accounts, we used to apportion this over a period of time. The period may be some number of years. Income tax says we will always take 5 years. So your deduction will be 1/5. Correct? Adil is asking me, sir, what is other resident non-corporate assessee? See, whenever this term will come. So now this section says we will allow deduction to two people. One is Indian companies or other resident non-corporate assessee. So Adil, you have rightly identified what does non-corporate means? Means other than company. So it will cover individual, HUF, partnership firms, LLP. So this section gives deduction either to Indian companies or to individuals, partnership firm, provided they are resident. So Adil, you have correctly identified it covers these people. So this is what is 35D preliminary expenses deduction. So first point, only the list of these expenses which is given over here, you have to consider, make a total of that. Second, compare it with the maximum limit given. Whichever is lower of these two becomes your eligible amount. And then third point is divided by 5 years. So whatever is the amount, you can claim deduction for 5 years after commencement. This is what is 35B. That is general preliminary expenses. Now on the similar lines, you have one more preliminary expenses, which is under 35DDA. Now what it says, if your employee is retiring under the VRS scheme. What is VRS? Voluntary Retirement Scheme. So many times you have to pay the VRS compensation, because when an employee retire before the retirement age, you have to give a lump sum amount, which is called as VRS compensation. Now this section says we will allow you deduction of VRS compensation subject to 2 points. One, it should be paid, that is, it should not be outstanding. And once it is paid, again we will divide it by 5, and this amount will be allowed to you in 5 years. So again, similar to preliminary, they are treating deduction of VRS by allowing this as deduction in 5 years period. Is this clear, students? Any questions, any doubts till this point? So we are now going to each of these sections, section wise in detail. I've only kept section 32 pending because that requires special working discussion. Other than that, now we are going to each and every section one by one in detail, right? Now with this, you complete the 35 list. Actually, see, 35 has many sections. We are only covering those which are applicable at inter level. At final level, you will read some more sections in 35. For the time being, we are limiting ourselves only to the inter level. Now, we go to the other two sections, 36, 37. But before that, we'll take a break because it is now around 1 hour 15 minutes we are discussing. Let us take 10 minutes break, and then we'll come back and discuss the remaining sections. Fine, students? Break. Hmm. Gautam is asking, sir, is preliminary expenses of specialized business fully allowed or one-fifth? See, that is what is Gautami I was trying to explain. For preliminary, you'll have multiple sections. Like for scientific preliminary, you have a separate section in scientific, then 35 AD. So when you are having specific preliminary, this one-fifth is not allowed, applicable. Like for scientific preliminary, entire amount can be claimed as deduction immediately. For 35 AD preliminary, entire amount can be claimed as deduction immediately. So specific preliminary are allowed as per their respective section, which is full in the first year itself. This is the common preliminary where they are saying that they will allow it over 5 years, right? Now coming to your next question, what about mining business? So for mining preliminary, again, there is a specific section of mining which says it will be allowed over 10 years. Only for mining preliminary, they have given 10 years. For other specific preliminary, it is full in the first year itself. And for general preliminary, it is one-fifth. Understood, beta? Yes. Now we go to section 36. Now in section 36, again, a list of different expenses is given. Now here, they have started with clause 3. I'll first explain what is clause 1, 1A, 2. Now these three clauses, they deal with 1A, 2, they deal with insurance. Now what these sections say? So these sections say that whenever you are making payment of insurance premium, so first is insurance premium on stock, insurance premium on life of cattle. So where cattle is your business asset, right? So insurance premium on stock. So you carry stock in your business, we insure it. Even in fact, in accounts, we have studied loss of stock policy. So that is dealing with insurance of stock only. Second, where cattle is required in your business because cattle is one of your asset, then insurance premium of cattle. And importantly, insurance premium on health of employees. Now, this is important. That is where you are paying mediclaim for employees. Now, this is also allowed as deduction. The only condition is it should be not in cash. So whenever you are paying medical insurance premium for your employees, it will be allowed as deduction with the condition that the premium should not be paid in cash. Now, please differentiate. Here, the only restriction is it should not be in cash. So medical insurance premium for ensuring the health of the employees, even if paid by cross check or bearer check, is allowed. So don't mix this with the 40A3 condition. 40A3, where the limit of 10,000 is given. Over there, the restriction is on bearer check also and cross check also. However, here in this section, the restriction is only that it should not be in cash. Importantly, this section does not allow insurance on life of employee. It is not allowed under this section. It only allows the medical insurance, which is on the health of employee. Now you'll ask, sir, then what if a businessman has taken insurance on life of employee? Remember one thing, if the business takes a regular insurance policy on the life of employee, like how we take on our lives or our family's life, that is never allowed as deduction. But if a company or an employer takes the key man insurance for their employees or partners or directors, then it is allowed as deduction under section 37, which we are going to study after this. So regular life insurance not allowed as deduction. Correct? Not allowed. Keep this in mind. Understood, students? So two things, medical insurance allowed, only condition it should not be in cash. And for life insurance, you should have taken this specific life insurance, which is the key man insurance. Then only that life insurance will be allowed. That also under section 37. Is this clear? Check. Gautami beta, see, I'm not explaining mining. Why? Because it is not part of your syllabus. But still, if you're asking, ki minery preliminary limit is applicable. So when we read the mining section, maybe at final level, over there, you will realize that they have given a time period limit for mining related preliminary, not a monetary limit. Right? Fine, Gautami? Okay, great. Now, students, coming to this 3613, what it covers? It covers interest. Interest on what? Capital borrowed, in simple words, loan. Now, many times you acquire loan for running your business. Now, it may be for day-to-day expenses or it may be for purchase of some capital asset. Everything is allowed as deduction under this section. Only you have to remember the four golden rules, because in all these sections, we have to always check the four golden rules. Now, when we talk about four golden rules, there is one interesting point. Whenever you have taken loan for the purpose of acquisition of asset, try to recall accounts. Whatever is the loan till the date the asset is put to use, right? So the interest on this period's loan, which period? Period beginning from the date of loan till the asset was first put to use. If you remember, we capitalize this interest. So the interest paid for this period, that is period before or up to the date the asset is put to use, our accounts also says all expenses till the date the asset is put to use or the asset becomes ready for use has to be capitalized. Same rule is given over here. This will be capitalized, and once it is capitalized, you can claim depreciation on it, but you cannot claim deduction here. So such amount of interest would be added to actual cost and it will not be allowed as deduction. So see, we have to compare, or we have to keep the accounting provisions also parallel in mind so that you'll understand these things. There is nothing very special or technical given over here. If you connect it with accounting standards, you'll find the answer is same. So interest which you are paying for the purpose of running your business, taking a loan for running your business, is allowed as deduction. Now, importantly, interest to proprietor not allowed. Interest to partners allowed, but we will study something in section 40 clause B where some conditions and restrictions are given. So within interest, these 2 points are important to be kept in mind, where the capital or loan is of the proprietor and interest is paid on that, no deduction in the Income Tax Act anywhere. But where it is the capital or loan of partner, interest on that is allowed. But for that, we have to study later section 40 clause B, restrictions and conditions, right? So these are important points about interest. Then comes these four provisions. What are these four provisions dealing with? They are dealing with contributions to employee welfare funds. I'm sure you know this. Again, four conditions. See, for all expenses, four conditions. Is it related to business? Yes, because they are your business employees. So their welfare is related to business. Is it current year? Is it revenue? Is it not an offense? Now you'll find that all these four conditions are satisfied. But besides this four condition, in our restriction, we have one section 40A bracket 9. What does 40A bracket 9 says? That even though all the four conditions are satisfied, but we will allow you deduction only if these funds are recognized or approved. If these funds are not recognized, not approved, we will not allow you deduction. Is this clear? So you have to keep this point in mind. Now, in all these sections, what is the difference? So clause 4 covers provident fund and superannuation fund. Clause 4A covers contribution to the National Pension Fund or the National Pension Scheme, which you study in ATCCD. Now here, there is a restriction. If you contribute to this fund in excess of 14% of the salary, the extra amount will be disallowed. So whatever is in excess of 14% of salary will be disallowed, because this section has put a limit that as an employer, you should contribute up to 14%. And then clause 5 covers the gratuity fund. Again, it should be approved. So in short, all funds relating to employees' welfare, whatever they are, provident fund or pension fund or gratuity fund, it is allowed as deduction because it satisfies our four golden rules, with one additional condition given in 40A9 that it should be approved or recognized, and one more additional condition only for the contribution to the pension fund or pension scheme, that is, it should not exceed 14% of salary. Now comes a very important clause in this. In all these three clauses, you were dealing with employer's contribution. You were dealing with employer's contribution. So firstly, all four clauses deal with this contribution to welfare funds. Within this, the three clauses deal with employer's contribution. And interestingly, this clause deals with now this is interesting. Now, since you have studied salary chapter, you'll understand this easily. So whenever there is a provident fund account or any employee welfare fund account, both people contribute. I also contribute. I am the business owner. So you all are my employees. So I have to contribute out of my pocket, which is employer's contribution, for which we studied the first three clauses. And equally, you also as employee contribute to your own fund. Now, interestingly, when you are contributing to your fund, it has no connection with me. You agree to this? However, interestingly, section 20, sorry, 2 clause 24, which deals with definition of income. This section says that whenever as an employer, now what I do, your contribution, I first collect it from you. How I collect it from you? I deduct that much amount while paying the salary. So I collect your contribution. Which contribution? Contribution of employees. Now, interestingly, section 2 clause 24, which is the definition section, definition of income, says that whenever I will receive or I'll collect this amount by way of deduction from your salary, this amount will be first treated as my income. So this amount which I deduct from your salary, which is your contribution, is first counted as my income. Now, once I deposit this, because I have to now deposit this, and this has to be deposited every month. So like now, we are in the first week of June. So May month has ended. Now I have started paying salary to my employees. Now when I'm paying salaries, I will deduct different amounts from your salary. One of the amounts is your contribution to various funds. Now these amounts which I have deducted, and this amount represents what your contribution to various funds, is first treated as my income as per 224. And now comes 36(1)(5)(a), which says that if I deposit this amount before due date, but which due date? Due date of the relevant act. Which act? Provident Fund Act, ESI Act, these acts which have created these welfare funds. So these acts have put some due date. Let us say 10th of the next month, 15th of the next month, 25th of the next month, whatever is the due date. I should deposit your contribution, which I have deducted from your salary, before the due date. Now, if I do that, I will get deduction. But if I do not do it before the due date, that is, I do it after the due date, I will not be getting this deduction. So this clause in section 36 deals with your contribution. For your contribution, firstly, definition of income says when I deduct it from your salary, I collect it from you, it becomes my income. And then 36(1)(5)(a) says I should deposit it before the due date of the relevant act under which this fund is created. If I do that, I get the deduction. But if I do it after this due date, then no deduction. So interestingly, students, for Provident Fund and other funds contribution, there are 4 clauses in 36. First 3 deal with my own contribution, which is always my expense. But for that also there is condition. 4 golden rules anyways are satisfied, but additional conditions, it should be approved, it should be recognized. And second, for pension fund, there is a monetary limit. Interestingly, for my contribution, that is all these 3 clauses, there is one more condition. We studied one more restriction under 43B. What does 43B says? I should pay it before the due date of filing my returns. Then only I'll get the deduction. Now, interestingly, for my contribution, that is employer's contribution, the time limit is up to the due date of filing returns. But for your contribution, which I have collected and deducted from your salary, the time limit is I will get deduction only if I deposit it before the due date of the relevant act, not the due date of filing returns. So within this, there is a bifurcation or there is a difference. For my contribution, I should deposit it before due date of income tax return filing. For your contribution, I should deposit it before the due date of relevant act. So this is the differentiating point. Fine, students. Then comes the next clause. It deals with what? Deduction for bad debts. Now, for bad debts, the simple requirement is check the 4 conditions. Is it related to business, the bad debts? Yes. It should not be of any capital amount. That is, it should be related to some revenue debts like debtors. Now, what is revenue? So it has indirectly this section condition says it is that debt which was taken into account in computing your income. Now, when you read this, it seems technical, but logically, if you think, who are my debtors? They are the one whom I have already shown as credit sales, and that sales I have already taken into P&L credit. That is, it has been taken into account in computing my income of any previous period. That is the period in which this sales had happened. Now, this same credit sales is what is appearing in my balance sheet as debtors. Now, in future, if these debtors becomes irrecoverable and I write off these amounts in my books, then I will be allowed as deduction in the year in which I write it off in my books. So the year in which I write off these bad debts in the books, in that year, the amount becomes deduction as bad debts. Is this fine, students? This, you remember we discussed when we were discussing golden rules, family planning expenses. Now, if you remember, this will be allowed only if you're a company. Both expenses are allowed, revenue and capital both. Revenue is allowed full, capital is allowed 1/5 over 5 years. Very important point, family planning expenses, maybe revenue or capital will not be allowed. Why or when? When it is done by a non-corporate assessee like individual HF, etc. So it is allowed only if the assessee is company. And then 2 more deductions. When you are in share trading business, so like people who are regularly doing share trading and share related transactions, for them it is a business. Now, when you do share related transactions, when you buy sell shares or when you buy sells commodity on the stock exchange, you have to pay two types of taxes to the stock exchange. One is the STT and one is the CTT. STT is the securities transaction tax, which is on securities, that is share, debenture, purchase, sale transaction. And CTT is when you are buying, selling commodities on stock exchange. Now, if it is your business to do share trading, commodities trading, then whatever STT or CTT you are paying to the stock exchange while doing these transactions obviously becomes your business deductions. This is what is the last two provisions of 36. Then we come to the last section which allows you deduction 37. Now this is a general deduction section. What do you mean by general deduction, students? Please understand. Now 30 to 36, what we discussed till now, were specific deductions. Like 30 and 31 covered rent, rate, insurance, etc. of assets. 32 covered depreciation. Then 35 covered different expenses like scientific research, preliminary, etc. etc. Then 36 we saw big list of expense. Now if you look at all these expenses from 30 to 36, still all expenses of a trading P&L are not covered. Like we have still not found any section for one of the major costs, that is purchases. Another major cost, wages. Another major cost, salary. Another major cost, advertisement. Right? These are some of your major costs that you are incurring when you are doing business. But till now, from 30 to 36, we did not find any section. Why? Because there is a last section for deductions, which is 37. What is 37 dealing with? See, 37 is named as general deduction. So it covers all the expenses which are not described in 30 to 36. So 37 will cover all remaining expenses. So I have listed few of them, some major expenses which businesses incur, right? Now all these expenses will be covered in 37, and again 37 puts the same condition. What? It should not be capital. It should not be personal. It should be for the purpose of business and profession. It should not be for any purpose which is offense, right? So the same golden rules applies to 37. And that is why when we were dealing with this chapter at the first two lectures, that is the practical part, I did not get into individual sections. But still, if you now see all the sections, you will find that the same four golden rules are applied, with exceptions for a few expenses like for scientific, for family planning, for 35 AD. But for all other expenses, the same golden rule applies. Now, some restrictions in 37. 37 has put some restriction. One major restriction is, now you all know what is a CSR. It is made compulsory by the Companies Act, Section 135, that every company has to spend some portion of their profit on CSR. Importantly, what does 37 says? Even though CSR is made compulsory and you as a company have to compulsory spend on CSR as per your main parent law, which is the Companies Act, still Income Tax Act says we will not treat it as an expenditure. So we do not allow deduction for CSR in income tax. Keep this in mind. So CSR expenses not allowed as deduction under income tax. Correct? Further, what is very important, 37 does not allow is where you are doing any expenses in the form of advertisement, where in any souvenir, brochure, pamphlet, etc. of a political party. So where you are putting advertisement in any political party's activities, in their brochure, in their rallies, we will not allow you deduction. Right? So this is the second restriction. So first restriction is CSR. Second is expenses done in the form of advertisement, but where it is done in some brochure, pamphlet of political party. Interestingly, what else they are saying? Now for this point, you have to understand a practical example. Now practically, a common thing that you find is that all these pharmaceutical companies, that is the companies which makes all these medicines, drugs, and all these things. Drugs means legal drugs, that is medicines. They all have tie-ups with different doctors because you purchase any medicine only when a doctor prescribes, correct? So what these companies have done, they give some benefit or perquisite to whom? To the person who is exercising a profession like a doctor. And these companies show these amounts as their expense because whatever commission, whatever benefits they are giving to the doctor so that the doctor prescribes that company's medicine, obviously it is a business expense for the company. However, 37 specifically disallows this. Why? Because there are various rules and guidelines like of Indian Medical Association and all these governing bodies which prohibits paying any benefit or any type of perquisite to the professionals. So legally, it is not allowed to give any such type of commissions to the doctors. And still, if the companies are giving and they are showing it as expense, income tax will not allow because these are prohibited expressly by some other act. So this automatically falls in our fourth golden rule that the expenses, if they are prohibited, will not be allowed as deduction. So this is one such example. So students, what you should understand, 37 is a residuary section, but it covers some major expenses, same golden rules applicable, and then the exceptions or the specific restrictions, CSR, advertisement in pamphlet brochure of political parties, and a common example where you are making payment of an amount which is prohibited by some specific law like the Indian Medical Association's rules, regulations that you should not pay any commission to the doctors for prescribing the medicine. Even if then the pharmaceutical companies are paying, it will be disallowed. Right, students? Clear to all? Now, we come to restriction sections. Now in restriction sections, first is section 40, clause A. If you remember what is disallowed in 40 clause A, two things are disallowed. First is direct tax. So wherever you are paying any direct tax, like your own income tax or income tax of the employee's perquisites, that is non-monetary benefits which you are giving to the employee, both these are direct taxes, your own or your employee's income tax, both are direct taxes, not allowed as deduction. Besides direct tax, what else was covered in 40 clause, if you remember, which we discussed in a lot of detail, is wherever you are making any payment and on that payment TDS was required to be deducted, which you have not deducted. So this point, similarly this point, where you are making any of these payments are made and TDS has not been deducted or after deduction has not been paid. Now, whenever these are payment to foreign persons or any person who is outside India that is non-resident, 100% is disallowed. So here also 100% and here also this salary, since it is paid to non-resident and TDS is not deducted, what is disallowed is 100%. But where the payment is made to a resident and the payment is made in India, and if again TDS has not been deducted or not been deposited when up to the due date of filing your returns, then how much is disallowed? 30% of the expense is disallowed. Right, students? Is this clear to all? Everybody recalls this? Then this is the specific section for partnership related. This we'll do in the next class. Then comes another restriction 48.2. What it deals with, where you are doing business with any related person. Now, who are these related persons? First, for individuals, your relatives. For firms, the partners and the relatives of the partners. For HUFAOP, the members of HUFAOP and their relatives. For company, the director of the company and the relatives of such director. These are specified persons. Plus, who else will be covered in this? Those businesses in which you are having substantial stake. Now, what is substantial stake? So, let us say you are running a proprietary concern, plus you are holding 20% or more of the shares of some company, or you are a partner in some partnership firm with more than 25% PSR. Then in such cases, this other company, this other partnership also is treated as a related person to this business. So related persons may be your relatives or partners, directors, and they may be the other businesses in which you have a substantial stake, which is more than 20%. Now, what does 48.2 says? Whenever you are having any expenses, that is, you are doing any transaction of expense with one of these persons, then I don't have a problem so far as the amount is not unreasonable. Now, how to decide whether the amount is reasonable? You have to check FMV, fair market value. So, what will be disallowed under 48.2 is wherever the payment made to any of these persons is exceeding the FMV. So this excess, that is the payment or the expenditure above the FMV of that particular item, the difference, which is the excessive part, will be disallowed. Then comes 48.3. Wherever you are making payment to a person in a day against a single invoice and it exceeds 10,000, the payment should be made by account pay, check, draft, or any of the prescribed online mediums. Then it will be allowed. If it is paid by any other medium, it will be disallowed. Now, there are two relaxations to this. First, for transport charges like freight, carriage, cartage, which are all transport charges, instead of 10,000, the limit will be 35,000. And then Rule 6DD has given a list of certain payments for which there is no limit. You can pay any amount in cash and it will be allowed. Like payment made to banks. Now this will be for interest. Payment made to government. This is of indirect tax. And payment made for purchase of raw items, that is agricultural items. And these should be purchased directly from the grower cultivator. Students, we have done all this. I'm just now taking you through the entire module so that our entire module is also covered in detail. And also this is a revision. Now, this is an interesting part. Now, what is this interesting part? What does this section says? Now, we talked about 48.3, which said what? That if you are making payment of any expense exceeding 10,000 and it is not by the prescribed medium, then we will disallow it, right? Now, understand this point. Now, what has happened? You are preparing trading P&L account for the financial year 24-25. In this, you have debited purchases rupees 2 lakhs. Now, in this year 24-25, this entire expense of purchase of 2 lakhs was outstanding. Why outstanding? Because it were credit purchase somewhere made in the month of February, March, and you did not pay it because the credit period was not over. Now, in this financial year 24-25, you have debited the expense, but the payment is not done. Now, since the payment was not done in 24-25, there was no question of applying 40A3. Why? Because 40A3 is triggered only when payment is made. Now, since no payment was made, so for these purchases of 2 lakhs, you did not check 40A3 because it was not applicable because no payment was made. Now, the payment of this was made in the next year. That is our present year for which we are going to do computation 25-26. Now in this year, you made payment for the purchases which is of last year. Now when you made payment, you made payment of this 2 lakhs in contravention of 48.3. That is, you should not have made payment in cash or bearer check or cross check, but you did that. Now, when you made payment of this 2 lakhs in 25-26 in contravention of 48.3, now what will 48.3 do? Now, generally what we say 48.3 says disallowed. Now, here in 25-26, this purchase is not debited in this P&L. It was debited in the last year. Now, what you will do is you will treat this as your PGBP income as per same section 40A 3A. So this 2 lakhs will now be treated as PGBP income in 25-26. Why? Because in 25-26, while making payment, you contravened the above provision. And since you contravened the above provision, so we need to make it taxable because you have contravened our provision. And how it will be taxable? By treating it as your income. This is what 48.3 says. And then 48.7 is what? Whenever you have gratuity, if the employee has retired in the same year, gratuity is fully allowed. But if employee is not retiring in the same year and you create provision for gratuity, then mere provision is not sufficient. You should also transfer the amount. You should contribute the amount to approved gratuity fund. Only then it will be allowed. Then 41 is the deemed income. You remember what is 41? My past year expenses, losses is recovered, reimbursed in the current year. And then last is 43B. What is 43B? Certain expenses will be allowed as deduction only if they are actually paid. Now 43B applies to those assessees who are following the mercantile system of accounting. It means they are debiting only those expenses which are accrued during the period. They may or may not be paid during the period because that is what is mercantile basis. Now when you are following the mercantile basis, then for all expenses, the deduction is allowed on due basis. But for these expenses, the deduction will be allowed only if these are actually paid. Now, what are these expenses for which payment is a condition? Payment of taxes. Which tax? Indirect tax to government. Then employer's contribution to funds, we just studied above. Then bonus commission to employee. Then interest either to banks, state financial corporations, or non-banking financial companies. So payment of interest. Then leave salary to employees. And last is use of railway assets for which you have to make payment to Indian Railways. So for all these payments, the condition is deduction is allowed if these amounts are actually paid. Till when? Till the due date of filing your returns under section 139(1). So if it is outstanding as on 31st March, it is okay. But ensure that before due date of filing of returns, that is before you file your returns, you make the payment. If you do that, I give you the deduction. If you fail to do this, the amount will be disallowed. You will not be getting deduction of that amount. Students, I hope this is clear to you all. Now in this, there is one more payment, which is to MSME. So whenever payment is to MSME, there is a specific time limit given in section 15 of the MSME Development Act. And it says that the time limit is maximum 45 days. 45 days from the date of expense. If you have not paid to the MSME up to 45 days from the date of expense, then that amount will also be disallowed under 43B. And again, it will be allowed in the year in which you make the payment. Fine, students. So this is all about all these sections in detail. I have left 2-3 sections like depreciation. I have left one more section, that is 40 clause B, that we deal with separately. And then there are a few theoretical sections relating to maintenance of books and audit. All this we will do in the next class. Now let me take you to the practical questions which I had asked you to solve. Now, when I go to the practical questions, I'm sure now you'll have a more clear understanding of what these practical questions were dealing with. So now see, in practical questions also, one, either you will be asked to compute the PGBP income by following the reconciliation format, or you will be simply asked to explain with reasons whether the particular amount is allowed or not allowed. Now, what are the points? First is you have opted out. That is, now you are in the old regime. Now, what is the difference? The moment you are in the old regime, special deductions also become applicable. What are the special deductions applicable to old regime and not in the new regime? Additional depreciation is allowed. Second, scientific research payment made to outsiders is allowed. All these special 2-3 deductions will be allowed to you, right? The third deduction is 35AD business. These three deductions are not allowed if you are in the old scheme. Now, going one by one, you have to discuss whether these are allowed or not. Construction of school building, and it is CSR. Now, importantly, this amount will be disallowed for both reasons. One, because it is capital. Capital is anyways not allowed. Second, we have just seen that section 37 specifically says CSR, even though compulsory by law, will be disallowed. So answer for this is disallowed. Two reasons. Next, purchase of building. Now this is again capital, but it is for specified business. What is that business? Warehousing of food grains, that is agricultural produce. This will be allowed. Now importantly, you are in the old scheme, hence you can claim this deduction under 35AD. Had this sum been of the new scheme, answer would have been disallowed because 35AD benefit is not available in the new scheme, right? Okay. Interest on loan. Now we just saw this interest on loan is allowed, but for interest, we have to also check TDS. Now, importantly, what is given? You have made payment of interest to X and for which tax has not been deducted. Now, X is given as a resident. Now, since tax has not been deducted, what is the problem? 30% will be disallowed. So, out of 50,000, 30%, 15 is disallowed. So, balance. What is the balance? 35,000 you can claim deduction now, but 15,000, which is 30%, will be disallowed. Next is commodities transaction tax. We just saw if you are in the business of share trading, this will be allowed. As per section 36, you can claim deduction of this if you are in share trading business. Now, is there anything given about share trading business? They are saying wholesale dealer of commodities. Nothing is given about share trading business. So we'll write a conditional answer if assessee is engaged in commodities trading business, it will be allowed or else disallowed. So you should write a conditional answer for this because at least in the question they have not specified whether you are in share trading business or not. The question only says you are in which business? You are in business of wholesale dealer of commodities. Next, again, you have to only explain whether it is allowed or not. So here also computation is not required. Now here you have to say whether the statements are true or false. So again, first you will decide allowed, not allowed. And then as per the sections, you will see whether it is true or false. Mac is asking, sir, 50,000 into 30% is disallowed and 35,000 is allowed. Is this giving two effects? No, but two effects are not given. See, right now we are not solving, we are only discussing allowed or not allowed. When we will be solving this, what will happen? We'll give only one effect. This 15,000 which is disallowed, we will add it in our reconciliation. Why? Because see, originally P&L has debited 50,000. So entire 50,000 is debited to P&L. Now out of 50,000, we are allowing 35,000. So 35 is allowed in PGBP. It means PGBP P&L will also debit 35. So the situation is accounting P&L has debited 50. PGBP will debit 35. So there is a difference of 15. So that 15 only we have to give effect when we are doing the reconciliation. So after these 2-3 sums, you will have There's someone solving also. When you'll get the solving sum, in that this disallowed amount will be added. So only one effect of disallowance is given. Again, you don't have to give effect of 35,000 because already the entire 50,000 was debited. What is Sridhar saying, sir? Commodity is disallowed. See, Sridhar, I've already mentioned this commodities transaction tax which you have paid, right? This will be allowed if you assume that you are engaged in commodity trading business. If you assume that you are not doing commodity trading as a business, then this will be disallowed. So now in the question, they have only mentioned that you are a wholesale dealer of commodities. So we will be writing a conditional answer for this. Fine, beta. Now, coming to the next question. What does the next question says? Again, you have to say true or false. So what is given? For a dealer in shares and securities, STT paid is permissible as deduction. Now, first you have to check whether this is permissible as deduction. Just continuing the above point. If you're in the business of security trading, then STT, CTT is allowed as deduction. Correct? This is what is the provision. And here also they are mentioning the same statement. It means the statement is true. Then you are following mercantile system and there is an expenditure of 25,000 which has accrued during the year, right? You make a payment of this 25,000 through cross check. 25,000 can be the PGBP under 48.3 in the year of payment. We just discussed that. So whenever you are making payment exceeding 10,000, the payment has to be made by account pay, check, draft, etc. What is not allowed is cash, bearer check and cross check is not allowed. Now, if in the same year in which the expenses is incurred, if in the same year the payment is made exceeding 10,000 in cash or cross check, you will disallow that amount. But as I was just explaining above, in this year, only the expenses is debited, payment is not made. Next year, the payment is made. And when in the next year the payment is made, it is made contravening 48.3. Now what we'll do in the next year? In the next year, as per 48.3, you will treat it as your PGBP income in the year of payment. So answer is true. We just understood this above. Correct, students? Somebody had asked me this as a query. In the homework sum, you have query of this. Who had asked me? Tanisha. Tanisha, beta, you had asked this. I hope you have understood. Good. See that if you were not able to understand, that was not wrong at your end because these are some very technical points that you understand as you understand the section in detail. Next, is it mandatory to provide depreciation? Answer is yes. This is what we studied in section 32. So again, this is true. Next, medical insurance policy, which you have paid for your employee, we just saw. The only condition is it should not be paid in cash. You can pay it by any other medium. Now you have paid the medical insurance premium by account pay check on this date. It is a deductible expenditure. Answer is true. Then 35 DDA, voluntary retirement scheme. What it says under this section, amortization of expenses incurred under eligible voluntary scheme at the time of retirement alone can be done. Answer is false. Why false? It is saying at the time of retirement alone. If you remember, the condition is it will be allowed 1/5 only when it is paid. So simply retirement alone is not sufficient. It should have been paid, and only from the year of payment, amortization will happen on in 1/5, that is over 5 years. So merely retirement happening is not sufficient. Payment should also be made. That is why this statement is false. Next, you are engaged in trading activity. You have exercised the option of shifting out of the new regime. So it means you are in the old regime. Now what is given? Can you claim additional depreciation? Yes, students. Additional depreciation. Isha says no. Anshika also says false. Very good. Why you cannot claim additional depreciation? See, firstly, additional is allowed only in old regime, and you are in old regime. That condition is satisfied. But still, you are not allowed. Why? Because for additional depreciation, if you remember today we discussed in the conditions, you should be a manufacturer. Here you are engaged in trading. So for trading, additional depreciation is not allowed in the old scheme. Old scheme allows additional depreciation only for manufacturer. So this will be false. Correct? Very good. Next, again, same point. You have to discuss whether it is allowed or not. Provision on actuarial valuation for gratuity. No payment is made. Whether the deduction is allowed. See, the condition under 40A7 for gratuity is first, either employee has retired, then allowed. If not retired, then you should transfer to gratuity fund, which should be approved. Now, since you have not made any payment, not transferred anything to gratuity fund, this will be not allowed. Because for claiming deduction, it should have been also transferred to gratuity fund. So either the employee should have retired in the current year, then payment was not required. But if it is not, if he has not retired, then you should have made payment of this to approved gratuity fund, which you have not done, hence not allowed. Next, you have purchased oil seeds from a farmer. Now, when you have purchased any agricultural produce from a farmer, then 40A3 is not applicable. Even if you make the payment in cash, it will be allowed. Here, nothing is mentioned about cash or what, but the point is you have purchased this, it will be allowed. There is no challenge. Correct? Very good. So see, now you all are getting the correct feel of the provisions. You have paid tax on the non-monetary perquisites of your employee. Again, as per 40 clause A, this is disallowed because it is a direct tax. Next, you have made payment of 50,000 by credit card for fire insurance. It is allowed. 36(1). Correct? Salary payment of 10 lakhs to Mr. X, who's outside India, by company without deduction. So what will happen? Salary is paid outside India and you have not deducted TDS. Again, as per 40 clause A, disallowed. Correct? And that also 100% yes. Entire amount is disallowed because the payment is made to a non-resident that is outside India. Very good. Next, you have made payment in cash of 30,000 to a transporter in a day. Now this payment is exceeding 10,000. It is made in cash. Allowed or disallowed as per 40A3. Very good. It is allowed. Why? Because for transporter, the limit is 35,000 and not 10,000. Very good. Very good. See, now you are getting the provisions and you are able to apply it to practical sums. Next, again, you have to decide whether the following statements are true or false. What is given? Payment is made in respect of business expenditure incurred on 16th of February. It is done by cross-check. Is it hit by 48.3? Yes. Business expenditure, payment through cross-check. Yes, it is exceeding 10,000. And once it is exceeding 10,000, it should be only by way of account paycheck. So this is not allowed. So it means it will be hit by, see now this is a language point. You have to understand the language also. So it is hit by 48.3 means it is not allowed by 48.3. So hit and not allowed means the same. So it is true. Next, what is B? It is a condition precedent to write off in the books of accounts the amount due from debtor to claim deduction for bad debts. Answer is true, because we just read that for claiming deduction of bad debts, there are two conditions. Condition is one, that it should have been shown as income in some past year. So if it is debtor, it means you have shown the credit sale in past year. So first condition satisfied. Second important condition, it should be written off in your books. So writing off in books is a condition. Yes. So this is also true. Next, failure to deduct TDS in accordance with provisions of Chapter 27B, inter alia, from the amount payable to a non-resident as rent, royalty, will result in disallowance while computing business income, where the non-resident pay has not paid the tax due on such income. Yes. True or false? But Sridhar, it is section 40 bracket small a. So for TDS, the section is 40 bracket small a. Correct? It is not capital A. It is small a. The answer is completely true or partly true. What they have said, amount payable to a non-resident as rent, royalty. See, for non-residents, there is a specific requirement. See, I'll just go back to that section. Sometimes it is a minute difference. See what is the minute difference here. So one payment to non-resident is about salaries only, and the other payment to non-resident, which is here, is of interest, royalty, and fees for technical services or other sums chargeable under the Act. So when they are saying or other sums chargeable under the Act, because now here in this question, two uh, amounts or expenses are mentioned. One is rent, one is royalty. Royalty is specifically mentioned, no doubt. What about rent? Whether rent is also covered here? Because if rent is also covered here in this point, then the statement becomes completely true. If you say rent is not covered here, then the statement is partly true, only true to the extent of royalty and not to the extent of rent. I was expecting this question. Now, if you see, when I was explaining you, I was writing the section numbers. Now, Mehak has raised a very, what do you say, sensitive question, which is always the question of every student, that do I need to write section numbers when I am giving the reasons? Mehak, answer is yes. Anyways, if you observe, Mehak, what are the sections which are relevant in all these points? They are all the restriction sections mainly. And at times, one or two sections are of the specific deductions. So anyways, the main sections, Mehak, will be between 30 to 43B, where mainly the sections that are required are of 40 clause A, 40A2, 40A3, 40A7, 43B. That is the restriction sections mainly. So I will request you all that you should focus on learning these sections. And how to learn? The answer is simple. See, you need not separately sit with a list to learn. That you can definitely do. But what I used to do is, whenever I am studying, whenever I am solving, most important, I will always write the section. So if you see here also, even though the section was written, while explaining, I had written. While explaining, I had written. See, this habit I developed from my study days, that I always write things. Even though it may be written there, I will rewrite it. Because when I write it, I am revising. My mind is revising. My mind is recollecting. So purposefully, when I'm solving here, I am writing everything. Why? Because that habit helps me in recollecting. That habit helps me in revising things effectively, right? So answer is yes, though this may sound painful to you, but let me tell you, it is not that bad. You can remember the provisions very, very conveniently. Only what you have to do is keep on repeating it. Now let me take this one more question. Now in this question, you have to solve it. Now while solving, what we follow the reconciliation format. So this becomes my starting point, and then we have to decide whether you have to add or less, correct? Now I'll just run through the adjustments. So there is some adjustment in the opening closing stock. There is some adjustment for a salary, for printing stationery, for depreciation, for rent, and for general expenses, correct? Now, what is given? You are required to compute profits and gains of Shivam under presumptive 4480. Now, see, students, we have not yet studied presumptive 4480. So you don't know how to compute this. You can keep this aside. We will compute as per the reconciliation what we have studied, right? Presumptive, that in the next class when we will study, that will be done. Yes, Mehak, this is what I am saying. If you revise every day, all these sections along with section number will be through. So just a request again to everyone, please revise. Now see, sales, is it part of PGBP? Yes. Closing stock, is it part of PGBP? Yes, but there is some adjustment. Now here, accounts is showing 1,86,000, and what it says, it was found that some stocks were omitted. So 18,000 closing stock was omitted. What does omitted means? Here, this amount should have been higher. That is, the amount in P&L should have been higher because one stock of 18,000 you forgot to write over here. So your amount reported here is less. Now we have to decide what to do of this 18,000. See, firstly, understand one thing. Undervaluation, overvaluation, all these things are done in accounts. Income tax does not do this. It simply says that you should take the fair value of everything. Now, if I have to take the fair value, then this closing stock in my PGBP P&L will appear with 18,000 higher. Now, what is the impact? Now you have to decide add or less. Now the impact is in your trading P&L, that is in your accounts, closing stock is 186. In my PGBP, the closing stock will be more higher than 186. How much higher? By 18,000. That is, there will be a difference. Now, because of this, since this is a credit item, closing stock is a credit item, so my profit is increasing. It is increasing in my accounts by 186, and in PGBP, it will increase by further 18,000. It means the difference is this. Accounting profit is here, PGBP here. PGBP profit will be higher by 18,000. My starting point is accounting net profit. I have to climb upwards. So my first adjustment is I'll have to add in my reconciliation 18,000 for the omitted closing stock. Very good, Gautam. Correct. Income from UTI. Now, like how you get dividends on shares, similarly on your investment in mutual funds of UTI, you get your dividends, which is called as income. This will be subtracted. Why? Because it is part of other sources. Again, accounting P&L has credited this, so accounting P&L profit is up because it is credit. PGBP says I will not consider this as my income. So PGBP profit remains here. Now you are standing here, that is accounting profit, you have to climb down, so subtract, right? Now we come to the debit side. Opening stock. Now opening stock is a PGBP item, but there is one adjustment. What is that adjustment? Again, in opening stock, some stocks are omitted. How much stock is omitted? 9,000. Now what is the impact of this? This amount correctly should be 99,000. But wrongly, this amount is debited in accounts as 90 because one stock of 9,000 is omitted. Now, what is the impact? See, this is accounts. In accounts, you have debited 90,000. So your profit is less by 90. But PGBP says we will debit the correct amount, which is 99. So PGBP profit is lower by 9,000. So this is the effect. So accounting profit is standing here, which is lower by 90. PGBP profit is standing here, which will be lower by 99. Because the correct opening stock should be 99. So there is a difference of this 9,000, because of which my accounting profit is higher. I have to come down. So I will subtract this amount in reconciliation. So while reconciliation, very good. Excellent, everyone. Purchases, again part of PGP. See, when I'm saying part of PGP means I'm applying those four conditions related to business, current year, revenue, not an offense. All are satisfied, but there is some adjustment for purchases. No. So it is allowed. Salary, again, all four conditions are satisfied. So it is allowed. However, there is one adjustment in salary. What is the adjustment in salary? 10,000 is paid to brother. Now, when you are paying some amount to your related person, we don't have a problem. The problem is only if it is excessive as compared to FMV. So what they have given, they have not given FMV, but they have already said that it is excessive by 2,000. It means this 2,000 is not allowed to PGBP as per 40A2. Now this 2,000 is to be disallowed. Now whenever you have to disallow, what it means that accounts is showing 60,000, the full amount. Income tax will only consider 58 because 2,000 is unreasonable, excessive, so it will not consider. So what is the impact? Accounting profit is lower by 60. PGBP profit will be lower only by 58. So this 2,000 difference you have to climb upwards. So it is disallowed, so you have to add. Correct? See, this add less what I'm writing is for the reconciliation format. So in reconciliation, you will have to add this. Correct? 2,000 Sridhar, not 12. I think it is a typo at your end. Very good, everyone. Now, next, rent rates taxes. Again, are four conditions satisfied? Yes. Is there any adjustment in rent rates? There was an adjustment which says it includes GST liability of 3,400 paid on 7/4. Now, which is the important section applicable over here? 43B. Why? Because it is payment to government. Payment to government is covered by 43B. And what does 43B says? Whenever you are making payment to government, it should be paid before the due date of filing returns. Now you have not paid it in your financial year. Your financial year is 25-26. You have not paid then, but you have paid in the month of April. Is it paid before filing of returns? Yes, your returns would be 31st of July, 30th, 31st of October, whatever. But you have paid it before that. So you have satisfied 43B. It means this amount, rent rates will be fully allowed because one, you have satisfied the four golden rules and also the restriction of 43B is complied with. Interest on loan, all conditions satisfied? Yes. Related to business, current year, not an offense. Any adjustment point given? No. So it is also allowed. Depreciation. Now depreciation always, it is allowed as deduction in PGBP under section 32, but the amount is always different. Why? Income tax and accounts have different workings. So what we do is either you can do the difference or simply you add this entire amount and subtract the amount which you get as per income tax. Now, what is the amount as per income tax that you have to calculate from here? Now, till now, you all have not studied the 32 depreciation calculation, which we are going to do in the next class. So right now, I'm just showing you the calculation. You can simply note down. So what is your opening balance? It is 4,20,000. A new plant is purchased on 1/7 for 70. So plus 70, which is new plant purchase, minus you have sold two of your old plants for 50. So as per PGBP provisions, WDB under section 43 subsection 6 is 4,40,000. On this, your normal depreciation will be 440 into 15. So it comes to 66,000. Additional depre is not applicable. Why? Because you are a trader, and for trader, additional depreciation is not allowed. Now, so final depreciation as per PGBP provisions is 66,000. Correct? Now, one you can do is you can find out the difference, or simply what generally module also does is for depreciation, the accounting amount is added and income tax amount is subtracted. Automatically difference is adjusted. Correct? Right, students? So Sridhar, you will do one of the things. Either you'll add and less, you'll do this, or the difference, what you mentioned, 39,000, you'll adjust the difference. So first option, add entire accounting depreciation and subtract entire income tax depreciation as I showed on the screen. Either do this. Second option is don't do this. Go to the difference between the two. The difference is 39 and then you have to do add or less. In this example, it will be add. Printing stationery, all four conditions satisfied, allowed. Postage telegram, all four conditions satisfied, allowed. Loss on sale of shares, short term. This is capital item. It is disallowed in PGBP. So add. Other general expenses, all four conditions satisfied, but there is one adjustment. One second. Sorry. There was an adjustment for printing stationery also. What is given? The whole amount of printing stationery was paid in cash. Okay, one second. Now this amount, four conditions are satisfied, but there is a problem. The problem is 48.3. Amount is exceeding 10,000. You should have paid it only by account, pay, check, draft. But they are saying you have paid the whole amount in cash. Disallowed. Students, I hope you understood this. As per four conditions, it was allowed. But as per adjustment, since the payment is exceeding 10,000 and it is paid entirely at one time and it is paid in cash, disallowed. Right? Okay. Then last point, general expenses. Again, there was an adjustment. Other general expenses include 2,000 paid as donation to public charitable trust. Now for donation, what was the rule I had given? If they are giving you donation under 35 section, only then it is allowed. If it is any other donation, it is disallowed. So here we will disallow 2,000, which is donation to public charitable trust, which is not part of PGB. Now we'll take the starting point as 50,000. You will add less all these amounts which we have marked, right? So after doing add less of all these amounts, you will get your final PGBP income. Students, I hope you are understanding this, right? Now, you are open to solve all the questions except the questions on depreciation, except the questions on partnership remuneration calculation, except these two and the last few theoretical sections like presumptive income. We have covered everything. You can definitely practice like the next one, 9 sum. You can practice 10th is on depreciation and other things you can leave. 11th you can check. 12th no, because it is partnership. 13th you can do, right? So you can now students solve these questions, and now the few sections which are left we will be completing in our next class. So students, I hope today's section would have given you a complete clarity, complete confidence. Either beta, for special economic zone, which is SEZ, we have a special deduction under 10AA, which is for their export profits. What you are saying, payment in SEZ, there is no restriction for payment in SEZ. SEZ has a special deduction for export profits, right? Okay. So students, I'm sure today's session would have given you a lot of clarity, most importantly, a lot of confidence. And with this, I will request you to kindly again revise all provisions and also solve sums, right? In the next class, we'll complete the remaining sections and our entire PGBP understanding part will be complete. Yes, practice. You have to keep solving module and past exam questions, MTPs, RTPs. They are very, very, very important. Okay, students. So thank you all. Thank you very much. Though we extended time, but I'm sure this will be the main concluding part of PGBP as far as the understanding is concerned, right? Please keep revising, keep studying. That will make the provisions thorough in your minds. So thank you, students. Thank you very much. Yes, Ashok ji, sorry for extending. Thank you, Ashok ji. Good day, everyone. Bye.
Recording stopped.